What if I told you the most profitable company on the planet just lost $256 billion in a single day, and the stock went down, not up, after posting the best quarter in corporate history? What if I told you the digital gold that was supposed to protect your money during uncertainty has lost half its value in 4 months? And what if I told you there is one asset class that has been quietly absorbing billions from both of those exits, and most Americans still have not figured it out? Today is February 28, 2026. This is the story of the Great Rotation, where the money is leaving, where it is going, and why the next 30 days could change everything. Let me start with the story that stunned Wall Street this week. Nvidia closed Thursday at $184.89, down 5.46%. The stock fell after blockbuster Q4 results, and strong guidance failed to ease AI bubble worries. Think about that for a moment. Nvidia generated a staggering $120 billion in profits last year, including an eye-popping $43 billion during the 3-month period ending in January, one of the strongest quarters of any business ever recorded. The market did not care. The stock cratered. With a total market value of roughly $4.5 trillion, that single-day loss amounted to approximately $256 billion in erased market cap. That is more than the entire GDP of Finland, gone in 6 hours. And it was not just Nvidia. CoreWeave tumbled 20% on Friday after its first quarter guidance fell short of expectations. CoreWeave is the AI cloud infrastructure company that Nvidia has invested billions into. CoreWeave is the AI-specialized cloud provider that relies heavily on Nvidia GPUs and accounts for over 86% of Nvidia's AI investment portfolio. Nvidia invested $350 million in CoreWeave in 2 tranches before its March IPO. Now here is the uncomfortable truth that Michael Burry, the big short investor, pointed out on February 26th. As Burry noted on his Substack, Nvidia has been forced to place non-cancelable purchase orders well before demand is known. This appears structural to the new trajectory of product development and not temporary. In plain English, Nvidia is making multi-billion-dollar bets on chips before anyone has agreed to buy them. That is not how a healthy supply chain works. That is how a company acts when the music is still playing, but the chairs are disappearing. The Nasdaq posted a decline of more than 3% in February, seeing its worst monthly performance since last March. The iShares Expanded Tech Software ETF is down nearly 10% for the month, bringing its year-to-date losses to almost 23%. Software stocks are down 23% in 2 months. That is not a dip. That is a sector in crisis. A National Bureau of Economic Research study published in February 2026 found that despite 90% of firms reporting no impact of AI on workplace and productivity, executives projected AI to increase productivity by 1.4% and increase output by 0.8%. 90% of firms reporting zero impact from AI. And yet, OpenAI committed to spending $1.4 trillion over 8 years building new data centers, with just $13 billion in revenue. This long-term spending is funded by debt. An estimate from Morgan Stanley put global spending on data centers between 2025 and 2028 at $3 trillion, half of which is covered by private credit. OpenAI has failed to present a reasonable roadmap to profitability. $3 trillion in spending, no profitability roadmap, half funded by private credit. And OpenAI's own internal forecast projects it will lose approximately $14 billion in 2026. This is why Wall Street is starting to panic, not because AI does not work, but because the math does not add up. And when the math stops working, the money moves. Where is it going? Let me show you. If AI stocks are the first exit point, Bitcoin is the second. Bitcoin has seen a sharp sell-off since October last year when it crossed $125,000, with the downturn extending into the new year. The world's largest cryptocurrency is down 27% so far this year and has lost 50% since the October high. 50%, half its value, gone in 4 months. Bitcoin's 4-month slump has come at a time when, in theory, it had everything going for it. Crypto bulls have long advocated that investors treat Bitcoin as digital gold, a new safe haven investment where traders can store funds when times are tough. So now would be a logical time for a safe haven to surge. But it is not surging, it is crashing. And the reason is structural. Crypto is down because of 6 overlapping factors that emerged and compounded throughout February 2026. Trump's sudden 15% global tariff announcement, a collapse in U.S. tech stocks that dragged risk assets lower, record liquidations topping $2.56 billion in a single weekend, a structural reversal in institutional flows as Bitcoin ETFs turned net sellers, a critical technical breakdown below Bitcoin's 365-day moving average, and escalating U.S.-Iran geopolitical tensions that are pushing investors into cash and gold. Let me focus on the institutional reversal because it is the most important part. In February 2025, U.S. spot Bitcoin ETFs were net buyers of 46,000 Bitcoin. In February 2026, CryptoQuant confirmed they are net sellers, a complete reversal that removes the institutional bid that had supported prices throughout 2025. The institutions that poured money into Bitcoin in 2025 are now pulling it back out. This is not retail panic. This is BlackRock, Fidelity, and their peers deciding that Bitcoin does not do what it was supposed to do when it matters most. Matt Hougan, Chief Investment Officer at Bitwise Asset Management, wrote, "This is not a bull market correction or a dip. It is a full-bore 2022-like Leonardo DiCaprio in the Revenant-style crypto winter." A crypto winter. Those are not my words. That is the Chief Investment Officer of one of the largest crypto asset managers in the world. Stablecoins like Tether and USD Coin lost nearly $14 billion from December through February. In 1 week alone, $7 billion disappeared. This means that when investors sell Bitcoin but keep money in stablecoins, they're just moving between crypto assets. When they redeem stablecoins for actual dollars, they're leaving the ecosystem entirely. They're not repositioning, they're exiting. And where is that exit money going? Safe haven demand saw spot gold trading over 1% higher Monday, showing a strong divergence from Bitcoin, which has often been referred to as digital gold. Gold is above $5,200, silver just closed at $94. Bitcoin cannot hold $65,000. Michael Burry recently wrote on his Substack that he believes gold and silver's extreme volatility in recent days is because Bitcoin bulls are selling off their metal positions to save face from crypto's slide. Michael Burry, the man who predicted the 2008 financial crisis before anyone else saw it coming, is telling you that Bitcoin investors are liquidating their precious metals positions to cover crypto losses. That is forced selling. And when forced selling ends, the underlying demand for physical silver reasserts itself. That is exactly what happened this week. Silver went from $86 on Monday to $94 by Friday. The forced selling stopped. The real buying began. Now let me connect the dots, because this is the part that matters for your money. At 8:45 a.m. Eastern Time on Friday, silver exchanged hands at $92.06 per ounce. That's a $4.99 uptick from 24 hours ago and more than a $60 gain over the past year. Silver gained nearly $8 in a single week. That is a 9% move in 5 trading days. Silver spot price is trading at $92.02 per ounce, up $5.02 or 5.77% on the day, outpacing gold by a wide margin and compressing the gold-silver ratio to 57.0. The gold-to-silver ratio at 57 is a historically significant level. When this ratio compresses below 60, it has historically signaled that silver is entering a phase of aggressive outperformance relative to gold. It is not at 70 or 80 where it normally sits. It is at 57, and it is falling. Scarcity of supply and growing demand, from both industrial applications and investors, have likely fueled silver's upward trajectory over the past year. Now here is the structural picture that makes this rally different from anything we have seen before. Money is exiting 3 places simultaneously. It is leaving AI stocks because valuations have become disconnected from profitability. Software stocks are down 23% year-to-date. CoreWeave crashed 20% in a single day. Even Nvidia fell 5% after record earnings. It is leaving Bitcoin because the digital gold narrative failed. 50% decline from the October high. ETF flows reversed from buying to selling. $14 billion in stablecoins redeemed and exited the crypto ecosystem entirely. And it is leaving the broader stock market because inflation just came in hot and shattered the rate cut narrative. Stocks dropped on Friday after the latest producer price index data came in much hotter than expected, adding sticky inflation to a list of concerns that has caused market turbulence this month. The Labor Department reported wholesale prices jumped 0.5% for the month versus the 0.3% forecast. Core PPI surged 0.8%, more than double the 0.3% expectation. That is not transitory, that is sticky. Bullish investors now account for only a third, 33.2%, of those sampled by AAII, down from a recent high of 44.4%. Contrarians follow sentiment readings because excessive bullishness can signal the market may be poised to decline. Nearly half of individual investors polled by AAII, or 49.5%, described themselves as bullish as recently as January 14th. Bullish sentiment went from 49.5% to 33.2% in 6 weeks. Fear is rising across every asset class, and in that environment, capital flows toward one thing: hard, physical, scarce assets. In December 2025, the year-over-year growth in U.S. margin debt exceeded the 12-month return of the S&P 500 by a substantial magnitude. The World Gold Council identifies this divergence as having occurred only 3 times in recorded market history, and each prior instance preceded a major equity bear market. For participants in the physical precious metals market, this is not a tactical signal, it is a structural alarm. When leveraged equity positions unwind, safe haven demand for physical gold and silver spikes, often violently and without warning. 3 times in recorded market history, every time a bear market followed, and every time precious metals spiked, Now layer this on top. President Donald Trump acknowledged he was facing a difficult choice in how to proceed with Iran after efforts at diplomacy have proved unsatisfactory. "We have a big decision to make," he told a crowd in Corpus Christi, Texas. The meeting plan comes after a third round of diplomatic talks between Iran and the U.S. on Thursday failed to produce a major breakthrough, and while President Donald Trump continues to weigh taking military action against Iran. Even while those diplomatic discussions took place, Trump was considering military options. Navy Admiral Brad Cooper, commander of U.S. Central Command, briefed the president on potential military options in Iran on Thursday. Vance claimed on Thursday that there is no chance that the U.S. would get involved in a protracted conflict in the Middle East. Still, he did not count out possible military action against Iran. "I think we all prefer the diplomatic option," Vance told the Washington Post. "But it really depends on what the Iranians do and what they say." Pressed on whether an attack on Iran would drive up oil prices, Trump insisted he wasn't concerned with the potential economic fallout, saying he was worried only with people's lives. "The President of the United States just told you he is not concerned about oil prices spiking if he strikes Iran. If the Strait of Hormuz is disrupted, even temporarily, oil spikes. When oil spikes, inflation accelerates. When inflation accelerates, the Fed cannot cut rates. When the Fed holds rates while the economy slows, you get stagflation. And in stagflation, gold and silver historically outperform every other asset class. This is not hypothetical. The military buildup is the largest U.S. deployment to the Middle East since the 2003 invasion of Iraq. The U.S. has placed F-22s on Israeli soil for the first time in history. All forces are expected to be in position by mid-March. The war premium is already priced into silver, but if kinetic action begins, it accelerates. And there is one more structural factor that almost no one is discussing. President Donald Trump on Friday evening said he signed an executive order imposing a new 10% global tariff, hours after the Supreme Court struck down his sweeping, reciprocal import duties in a major rebuke of his trade agenda. "The Section 122 tariffs will take effect almost immediately," Trump said. "They come on top of the levies that remain intact following the High Court's decision." The Supreme Court struck down Trump's IEEPA tariffs in a 6-3 decision. The court's majority ruled that IEEPA does not authorize the president to impose tariffs. Trump immediately responded with new tariffs under Section 122 of the Trade Act of 1974. Then on Saturday, he raised those tariffs from 10% to 15%. The proclamation imposes, for a period of 150 days, a 10% ad valorem import duty on articles imported into the United States. The temporary import duty will take effect February 24th at 12:01 a.m. Eastern Standard Time. Some goods will not be subject to the temporary import duty because of the needs of the U.S. That exemption list includes certain critical minerals, currency metals, and bullion. Silver and gold are exempt. The federal government just told you in writing that silver and gold are not ordinary commodities. They are strategic. They are essential. They are protected. Trump's approval ratings are at or near record lows, and voters are blaming his policies, particularly his tariffs, for making things worse. In this speech, he doubled down on those tariffs. This tariff regime is not going away. The Section 122 tariffs have a 150-day clock, expiring in late July unless Congress extends them. That means 5 more months of trade uncertainty, 5 more months of inflation pressure, 5 more months of safe haven demand. After a slow January, buyback authorizations surged to $233.3 billion in February, the largest February on record and the third largest month ever, according to data from Burry Associates. Corporations are spending $233 billion buying back their own stock instead of investing in growth. They are telling you they see limited opportunities ahead. When corporations hoard and protect, it is a defensive signal. So let me tell you what the next 30 days look like. JP Morgan has already raised its year-end 2026 gold price target to $6,300 per ounce. If JP Morgan is right about gold at $6,300 and the gold to silver ratio holds near 57, basic math puts silver well above $100. If the ratio compresses further toward 50, which it did earlier this week, that same gold target implies silver near 126er. March is a primary delivery month for silver futures on COMEX. On Friday, First Notice Day saw over 52 million ounces demanded for March delivery against approximately 86 million ounces of registered inventory. In the last 60 days alone, nearly 75 million ounces have been physically pulled from COMEX warehouses. The price of silver sits significantly higher than where it was in recent weeks, but still lower than the 100+ per ounce record it broke in January. Silver's all-time high of 121.67 was set on January 29th. After a historic 31% single-day crash on January 30th, it dropped into the 70s. It has now recovered more than $20 from those lows and is accelerating. The steady prices mark the 4th consecutive session of consolidation after the sharp recovery from the February low. Consolidation followed by breakout. That is the pattern. And the next target everyone is watching is $100. Most prediction markets and analysts currently assign low odds, less than 10%, to Bitcoin reclaiming $100,000 before the end of February. Instead, the consensus points toward a trading range between $64,000 and $75,000 as the market searches for a definitive bottom. Bitcoin looking for a bottom, silver looking for a breakout. That is the divergence. That is the great rotation in real time. Here is what converges in March. The Iran military deadline. All forces in position by mid-March. COMEX March delivery. The most critical physical silver delivery month of 2026. Tariff uncertainty. 15% global tariffs with a 150-day countdown. Hot inflation data, rate cuts being pushed back, stagflation risk rising, Bitcoin's continued decline, institutional flows reversed, the crypto winter deepening, and AI bubble fear. 90% of firms seeing zero productivity gains from AI while trillions are spent on infrastructure. Every single one of these forces pushes capital toward the same place. Physical, scarce, strategic, real, silver. Now let me be real with you. Silver is not safe. Silver dropped 31% in a single day last month. It is one of the most volatile assets on Earth. If you cannot stomach seeing your investment lose a third of its value overnight, this is not for you. Nobody knows if war with Iran will happen. Nobody knows if the AI bubble will pop or if it will reflate. Nobody knows if Bitcoin bottoms at $60,000 or crashes to $38,000 as Stifel's Burry Bannister has suggested. And nobody knows if silver hits $100 next month or pulls back to $80. What I can tell you is what the data shows as of February 28, 2026. Silver's gains over the past year have outpaced gold, and many analysts anticipate continued strength, expecting possible new highs for silver. Nvidia lost $256 billion in a day after the best quarter in corporate history. Bitcoin lost 50% from its October high while gold gained. The S&P 500 just posted its worst month since March. Inflation is hotter than expected. The U.S. military is preparing for potential action in Iran. Tariff chaos is reshaping global trade, and silver closed the week at $94 after gaining nearly $8 in 5 days. The smart money is rotating. The question is whether you see it. March could be the most important month of 2026 for precious metals, for stocks, for crypto, and for the global economy. I will be covering every development here. If this video connected dots for you that you had not seen before, smash that like button, subscribe so you do not miss Monday's update when markets reopen, and drop your answer in the comments. Where do you think silver is headed in March? I want to hear from you. This is your market. Stay sharp. This video is for educational and entertainment purposes only. Nothing presented here is financial, investment, tax, or legal advice. All market data referenced reflects publicly available information as of February 28, 2026. Precious metals, cryptocurrencies, and equities are highly volatile investments. Past performance does not guarantee future results. Please consult a qualified financial advisor before making any investment decisions. The creator of this video assumes no liability for financial decisions made based on this content.